There is a war happening right now. No bombs, no missiles, no headlines. Just quiet, deliberate moves by governments, central banks, and financial institutions, all aimed at the same thing, the dollar. And the strange part? Most people have no idea it's even happening. Not because the information is hidden. It's out there in dry press releases, in central bank reports, in trade agreements buried under thousands of pages of legal text. It's hidden in plain sight behind language so boring, so technical, so deliberately forgettable that most people scroll past it without a second thought. But what's happening right now, quietly, steadily, and with increasing speed, could be one of the most consequential economic shifts of the 21st century, and you deserve to understand. Let's start with something you already know. The US dollar is the world's reserve currency. You've heard that phrase, but what does it actually mean in practice? Here's the simplest way to think about it. Imagine every country in the world is a business. Each one produces things: oil, wheat, microchips, cars. And when two of those businesses want to trade with each other, say Brazil wants to buy oil from Saudi Arabia, they need a common language, a common currency. For the last 80 years, that common currency has been the US dollar. So Brazil converts its reais to dollars. Saudi Arabia accepts those dollars. The deal gets done. This sounds like a logistical detail, a footnote, but it is in fact the foundation of the entire modern global economy, and the United States sits at the center of it. Now, here's where it gets interesting. When the whole world needs dollars to do business, and only the United States can create dollars, that gives the US an extraordinary, almost absurd advantage. Economists call it an exorbitant privilege. The French finance minister, Valéry Giscard d'Estaing, coined that phrase back in the 1960s, and he meant it as a complaint. Because here's what the privilege actually looks like in practice. The US can run massive trade deficits, buying far more from the rest of the world than it sells. And it barely matters. Why? Because the world will keep accepting dollars anyway. The world needs them. The US can borrow at lower interest rates than almost any other country on earth because everyone wants to hold US debt. It's considered the safest asset in the world. And perhaps most powerfully, the US can use the dollar as a weapon. Sanction a country, cut off their access to the dollar system, freeze their reserves, lock them out of global trade. That's not a theoretical power. That's something the US has done repeatedly against Iran, against Russia, against North Korea, against Venezuela. The dollar isn't just a currency, it's infrastructure, it's leverage, it's power.
Now, if you were another country watching all of this, what would you think? You'd probably think, this is an unfair game, and you'd be right. But more importantly, you'd probably start thinking about how to change it. That is exactly what's been happening, slowly, quietly, for years. And now it's accelerating.
Let's talk about what's actually moving. In 2022, the US and its allies did something unprecedented. After Russia invaded Ukraine, Western nations froze approximately $300 billion in Russian central bank assets. Just frozen, gone from Russia's reach. To most Western audiences, this seemed like a logical and proportionate response. But to every other central bank in the world, in China, in India, in Brazil, in Saudi Arabia, in Turkey, this sent a very different message. The message was, your dollar reserves are not actually yours if Washington decides otherwise. Think about what that means. Central banks hold foreign currency reserves as a form of insurance, a safety net. The whole point is that they're available when you need them most. Russia had roughly $640 billion in reserves. They spent years building that cushion, and almost half of it became inaccessible overnight. For any country that isn't fully aligned with US foreign policy, and there are many, that was a wake-up call. If it happened to Russia, it can happen to us. And so the question that started circulating quietly through the corridors of finance ministries and central banks around the world was this: how do we reduce our dependence on the dollar? Not eliminate it. That's unrealistic in the short term. The dollar is too embedded, too liquid, too universal. But reduce it. Hedge against it. Build alternatives. And that's exactly what started happening. China has been the most aggressive player in this story, and the numbers are worth understanding. China has been systematically expanding the use of its own currency,
the yuan, or renminbi, in international trade. In 2015, the yuan accounted for roughly 2% of global payments. By 2023, that had climbed closer to 4 or 5%. Still small, but the direction matters. More significantly, China has been striking bilateral trade agreements with countries to settle transactions directly in yuan, bypassing the dollar entirely. Russia now settles a large portion of its trade with China in yuan. Saudi Arabia has had discussions about pricing some oil sales in yuan. Brazil and China announced a trade agreement to use their own currencies directly. Argentina, facing a dollar shortage, started paying for Chinese imports in yuan, one by one, country by country. None of these moves is dramatic on its own, but add them up and you start to see a pattern.
Then there's gold. Central banks around the world have been buying gold at the highest rate in decades. In 2022 and 2023, central bank gold purchases hit their highest levels since the 1960s. Not individual investors, not hedge funds, central banks. The institutions that are supposed to be the most conservative, most deliberate actors in the global financial system. China has been buying. Russia has been buying. Poland, India, Turkey, Singapore, all adding to their gold reserves. Why? Gold is no one's liability. It can't be sanctioned. It can't be frozen by a foreign government. It doesn't depend on any country's financial infrastructure. In a world where dollar reserves can be frozen at the stroke of a pen, gold starts to look very attractive again.
And then there's BRICS. BRICS started as an acronym: Brazil, Russia, India, China, South Africa. An idea more than an institution. But in 2023, it expanded. 6 new countries were invited to join: Saudi Arabia, the UAE, Iran, Egypt, Ethiopia, Argentina, though Argentina ultimately declined. And the conversation at the BRICS summits has become increasingly explicit about one goal: reducing dollar dependence, creating alternative financial channels, building a multipolar monetary system. There has been talk of a BRICS currency, something that could be used to settle trade between member nations. The details are vague. The timeline is uncertain. The obstacles are enormous. But the fact that this conversation is happening at all, at the level it's happening, is significant.
Now, here's where I want to slow down and be honest with you. Because there is a version of this story that gets told in a very dramatic, almost apocalyptic way. The dollar is collapsing, the empire is falling, the end is near. That version is almost certainly wrong, at least in any time frame that's relevant to most people's lives. The dollar still accounts for roughly 58 to 60% of global foreign exchange reserves. The next largest is the euro at around 20%. The yuan? About 2.5%. The dollar is still the currency in which most commodities are priced: oil, gold, wheat, copper. The US financial system, its depth, its liquidity, its legal infrastructure, has no real competitor, not yet. And creating a new global reserve currency is genuinely, almost impossibly hard. It requires trust built over decades. It requires open capital markets. It requires legal systems that foreigners believe will protect them. China, despite its size, does not have those things. So if you're expecting a sudden collapse of dollar dominance, that's probably not the story.
But here's the uncomfortable thing. You don't need a collapse for this to matter. Even a slow, gradual erosion of dollar dominance has real consequences. If the dollar's share of global reserves falls, say from 60% to 40% over the next 2 or 3 decades, that changes things. The US would face higher borrowing costs. The exorbitant privilege starts to shrink. Running large deficits becomes more expensive. The ability to sanction countries becomes less effective if there are alternative financial rails to route around. And perhaps most unsettling, the political leverage that comes from controlling the world's reserve currency starts to diminish. The US has wielded that leverage for 80 years. It has shaped foreign policy, trade policy, military strategy. What does American foreign policy look like in
in a world where the dollar weapon is less sharp? That's not a hypothetical. That's a question that some very serious people in Washington are actively wrestling with right now. There's also a deeper irony here that deserves to be named. The United States, in some ways, helped create the conditions for this challenge. Every time the U.S. used financial sanctions as a geopolitical tool, and it has used them extensively against more countries than most people realize, it reminded the rest of the world of their vulnerability. Every time U.S. domestic politics created uncertainty about the debt ceiling, about whether America would honor its obligations, it reminded foreign creditors that U.S. debt is not as risk-free as it was once assumed. Every time the U.S. printed trillions of dollars during the 2008 crisis, during COVID, and those dollars flooded into emerging markets, creating inflation and instability in economies that had no say in the decision, it reminded those countries that they were passengers in a system they don't control. The dollar's dominance was built on trust, and trust is the one thing that, once eroded, is very hard to rebuild. So, where does this leave us? Here is what seems most likely, based on what's actually happening rather than what makes for exciting headlines. The dollar will remain dominant for years, probably decades, but its dominance will be gradually contested. A messier, more fragmented monetary system is emerging, one where different regions increasingly transact in different currencies, where dollar dominance in trade slowly diverges from dollar dominance in reserves. The U.S. will retain enormous financial power, but it will be operating in a world that is slowly, deliberately building alternatives, not to defeat the dollar, but to have options. And the countries doing this most aggressively are not small, weak actors. They are China, India, Saudi Arabia, Brazil, economies that collectively represent a majority of the world's population and a growing share of its GDP.
Here is the question I keep coming back to. The dollar's dominance was not inevitable. It was a consequence of specific historical circumstances: the aftermath of World War II, the Bretton Woods Agreement, American industrial and military supremacy. Those circumstances created a system, and that system has been remarkably stable. But systems don't last forever. They adapt, they shift, they sometimes break. The question is not whether change is coming. Some version of change is already here. The question is whether the people who run the current system, in Washington, in the Treasury, in the Federal Reserve, understand what they're actually risking. Because the dollar's power was never just about economic strength. It was about trust. And in a world where that trust is being quietly, deliberately, systematically tested, the most important question isn't who wins the war. It's whether anyone in charge has noticed it's already started.